All right, let's just jump right in. If this is your first time looking at the market, wow, that wall of red probably feels like walking straight into a hurricane, right? It's intimidating, for sure. But don't worry, think of me as your guide today. This is your very first market briefing, and we're going to get through this together. And look, seeing all those numbers just plunging, it is absolutely overwhelming. That's a totally normal reaction. But here's the plan for today, and it's a simple one. We're going to take all that confusion and turn it into clarity. Seriously, by the time we're done here, you won't just know what's happening, you're going to understand why. So here's our game plan. First up, the briefing. Then we'll learn the language of the market. Use it to decode today's Red Sea, talk about the smart strategy of doing nothing, and wrap up with your first trading mission. It's a clear path forward. Okay, part one, your first market briefing. We're going to build our knowledge from the ground up. You can't understand the big story without knowing the words. So we're starting with the absolute basics, the essential vocabulary. Which brings us right to section 2, the language of the market. We're just going to focus on the big 3. These are the core terms you absolutely have to know. Get these down and you're well on your way to sounding like you know what you're talking about. First up, what even is a stock? It sounds kind of complicated, but trust me, it's not. Just picture a company like a giant pizza. Buying a stock, or a share, is like buying one slice of that pizza. You own a tiny piece of the whole thing. And hey, if the pizza place does really well and everyone wants their pizza, your slice becomes worth more money. It's really as simple as that. Okay, next up is an index. You hear about the Nifty 50 and the Sensex all the time, right? Well, think of an index as a shopping basket. The Nifty 50 is just a basket holding the stocks of the 50 biggest companies in India. The Sensex holds 30. So when you hear on the news the Nifty is down, it just means that on average, that whole basket of big companies is losing value. It's like a quick health check for the entire market. And last but not least, let's talk about the market's 2 famous animals, the bull and the bear. It's super simple. A bull market, that's when things are going great, prices are rising, everyone's optimistic. Just think of a bull charging and thrusting its horns up. A bear market is the total opposite. Prices are falling, fear is everywhere. Think of a bear swiping its big paws down. And yeah, today we are definitely in a bear market. Okay, vocabulary, check. Now we're ready for section 3, where we get to be analysts for a day. We're going to take our new words, our new language, and apply them to figure out exactly why we're seeing this sea of red today on March 14th, 2026. So, what's the trigger? The big thing to understand is that today's drop isn't random. This whole bearish vibe we're feeling, it was kicked off by a major event happening overseas, a geopolitical shock. Markets absolutely hate uncertainty, and this conflict in West Asia has just dumped a whole lot of it on everyone. And that shock has had a very real, very direct impact on the economy. The price for a single barrel of crude oil has exploded past $100. Now, for a country like India that has to import most of its oil, that number isn't just a number, it's a massive flashing red alarm bell. And that alarm bell sets off a chain reaction, kind of like dominoes falling. First, the oil price surges. Then, that makes everything more expensive for Indian companies. I mean, think about fuel for their trucks, raw materials for their factories, all of it. So their costs go up. And when costs go up, profits are expected to go down. And that makes investors really nervous, so they start to sell their stocks. That's what we call selling pressure. And here you can see the result of all that selling pressure. This isn't just theory. It translates into hard, cold numbers. The Sensex dropped by almost 1,500 points. The Nifty 50, our basket of the biggest companies, fell by over 480. That sea of red we talked about at the beginning, this is exactly what it looks like on paper. But besides the prices, there's another number we need to look at. It's something that actually measures the emotion of the market. And it has a pretty cool name. It's called the fear gauge. So its official name is the VIX, or the Volatility Index. In simple terms, it tells us how much panic and anxiety is out there. And right now, it's spiking. A high VIX is a huge signal that fear, not careful calculation, is in the driver's seat. It means investor panic is high. Okay, so we get the what and we get the why, but that brings us to the most important question for a beginner. What in the world are you supposed to do right now? Well, this leads us to section 4, and a powerful strategy I call the art of doing nothing. There's this classic saying in the investing world, Don't try to catch a falling knife. Just think about that for a second. It means that trying to buy stocks when the market is crashing like this is incredibly dangerous. You might think you're being clever and buying a bargain, but you're way more likely to just get hurt as the prices keep dropping. So instead of jumping in and trying to catch that knife, here's what you do instead. First, just watch, observe. Keep an eye on that 23,000 level for the Nifty. It's a big psychological line in the sand. Second, remember that holding onto your cash is a perfectly valid strategy. In fact, right now, it's a smart one. Cash is a position. And third, keep an eye on the rupee. If it gets weaker, foreign investors tend to sell off even more, which could push the market down further. And that brings us to our final section for today, your first trading mission. Now it's time to take everything we've talked about, all this theory, and actually put it into practice. Don't worry, this is simple, it's safe, and it's going to make all these ideas really stick. When you look at a chart during a bear market, you'll often see a very specific pattern emerge. It's the visual proof of that downward pressure we discussed. So my question to you is this: can you see the staircase going down? Let me show you what I mean. Imagine the market closes at a certain point on day 1. Then on day 2, it closes a little bit lower. And on day 3, it closes even lower than that. See? It creates this visual pattern that looks just like a staircase, heading down. Spotting this pattern is like learning to read the market's body language. So here it is, your mission. Sometime today, I want you to go to a financial news site. Money Control, Google Finance, doesn't matter. Pull up the chart for the Nifty 50. Change the view to the 5-day chart, and your only job, your only goal, is to see if you can find that downward staircase pattern. That's it. You're not buying anything, you're not selling, you are simply training your eyes to see what's really happening. And just like that, you finished your first market briefing. You learned the language, you analyzed a real-world event, and now you have a mission to train your skills. We've covered the what and the why of a market drop. Next time, maybe we can get into the how of trading. So that's my question for you. For our next explainer, should we break down how to read a basic stock candle chart? Let me know what you think.